Gilbert, WealthWise Financial. Thank you to everybody who's joining our call. The municipal bond market has been in as much of a rout as the equity markets have been. And I'll tell you, I was in the business in 1994, and this is worse than 94 as far as the volatility that we're seeing altogether in fixed income. So we are going to have an expert with us, portfolio manager on a muni bond strategy that we utilize here at WealthWise, joining us today. So with that, Dan, I'm going to go ahead and turn it over to you to, and the good news, let's just start. The good news is that we've actually seen some rallying in the municipal bond market. So it seems like having these calls are always timely. And like we said last week, Dan, we should just keep doing calls so that we get some recovery in the markets, right? So Dan, I'll turn it over to you, Dan Melhan with Alliance Bernstein AB.
First of all, Loreen, can you hear me?
I can, thank you.
Okay, thank goodness. So thank you very much, Loreen, for giving us the opportunity to visit with you and your clients today. As you mentioned, thank goodness, my fingers were crossed. We had a very nice rally in the muni market last week. Tax-free municipal bonds were up on average 2.86% last week. So as Loreen just mentioned a couple minutes ago, we're going to do calls and Zooms every other day in order to keep the markets up. I have the distinct pleasure of introducing all of you to my favorite portfolio manager in the tax-free municipal bond market. His name is Daryl Clements. Daryl joined us at Alliance Bernstein in 2002. He joined us, and now he's coming up on 20 years. And Daryl Clements, when he joined us originally, he started out as an analyst. And in 2006, he was promoted to portfolio manager. Now, he and his team manage tax-free municipal bonds in the format of a separately managed account, which Loreen uses for her clients, and they also manage tax-free municipal bonds through mutual funds. What's really important for you to know is that independent of whether it's on the separately managed account side or the mutual fund side, Daryl has built a tremendous reputation for delivering fantastic investment results according to Morningstar on an objective basis, on an absolute basis, and then most importantly here at Alliance Bernstein on a risk-adjusted basis. So what he's going to do is he's going to walk you through a little bit of what has happened in the municipal bond market so far year to date, going to give you an idea of what they're doing within the portfolios now. And then lastly, he's going to share with you what our outlook is going forward. So what I'd like to do at this point is turn it over to Daryl Clements. Thank you very much, Loreen. Is Daryl on?
Yes, Daryl's on. And Daryl, thank you so much for joining us. We've had a number of calls with Daryl. And so Daryl, you know, some of the people on this call have attended some of your other webinars that we've done and some have not. And okay. So if you will please start with the overview, that would be great.
No, I would love to. Thank you, Loreen. I appreciate it. And Dan, thank you for the kind introduction. So it has been a rout. You're right, Loreen. We've gone, you can go back, you have to go back to 1981. For a worse municipal bond market. So you're right, 94 was not as bad as it was this year. So what happened? But I think that's really important to know. Why has municipal bonds been more volatile this year? More volatile than treasuries and more volatile than corporate bonds. And that is not normal, right? So what's happened? So give me a little latitude here real quickly. Municipals had a really good year last year. They had positive performance. U.S. Treasuries did not. They had negative performance. So when you're looking, when you have a municipal bond, you tend to compare it to a treasury because they're both risk-free assets. So coming into this year, municipal bonds were expensive. And what I mean by that is there's always a relationship between municipal yields and treasury yields. So for example, you buy if you look at a ratio or what percentage of municipal yield should be of a treasury yield. It should be, depending on the maturity, somewhere between 75 and 95%. So municipal yield should be 75 to 95% of a treasury yield. Coming into this year, it was 35 to 65%. So municipal yields were far below treasury yields because they had a good year last year. Remember, right? So prices went up, yields came down. So they looked relatively very expensive. So what happened in January, and I kind of view this year as a year in two stages. So stage one, the municipal market just said no more. We're just not buying bonds at these yield levels anymore. And within the month of January, Treasury yields rose, but municipal yields doubled the move of a Treasury move. So they moved much more sharply higher. But what that did was take bonds that were expensive, municipal bonds whose yields were down here and treasuries were here, and moved them right up to here to become more fair value, more in that 75 to 95% range, okay? But then what happened in February, March, April, and then into May, at least in the beginning of May? And a little different story, that's stage two. There have been outflows in the municipal market. So retail investors who got spooked by what happened in January and the anticipation of further yield increases by the Federal Reserve, they started to exit the municipal market. So far, year to date, there has been roughly 60 billion of outflows. So, and the best way to gauge that is looking at mutual fund flows in the municipal market. So $60 billion has exited the municipal market. Now, we're in a very enviable position. We have inflows coming in, so we're kind of bucking the trend of the market, which puts us in a very enviable position because now, you know, we have cash coming in to buy bonds at higher yields. That's exactly where you want to be. But those outflows, think about what happens when you have outflows. If you're a manager, you have to meet those redemptions. So in order to meet those redemptions, if you don't have enough cash, you need to sell bonds. And you need to sell bonds on the secondary market. So what happened was during February, March, April, and into May, there was so much in the way of secondary market supply. A lot of managers looking to sell bonds to meet this 60 billion in outflows. There was just too much supply and not enough demand. So that took, we all saw it in our portfolios, right? So we saw prices going down and yields going even higher. So remember when I told you about that ratio that in January it reached anywhere between 75 to 95? Well, about 2 weeks ago, that reached anywhere between 95 and 110%. So in many instances, municipal yields are now above treasury yields. So they became too cheap. So one thing I can tell you is you can, how do I say this? Nothing will stay expensive forever and nothing will stay cheap forever, no matter what it is. It could be an equity, it doesn't matter. Nothing will stay super high in price forever. Nothing will stay really low in price forever. So what was happening in the municipal market as we came into January or into May, they were looking very, very cheap. And let me give you an example of some bonds that we bought. So California, okay? Two examples in California. Just a plain old California state general obligation bond, one of the most liquid bonds in the market, very big issuer, everyone owns them, especially in California. It's roughly 25% of the California market, the California state general obligation bond is. And that bond typically comes with a spread, and what I mean by a spread is the yield that California is paying versus a AAA rated bond, a regular AAA municipal bond. And usually you'll get about maybe 5, 10 basis points. Sometimes you'll earn even less, right? You earn more in a national bond, AAA bond than a California bond. But today, or upwards, up until about a week ago, you were picking up about 1% more to own a California bond relative to a AAA rated bond. What that tells me is that when these redemptions were occurring, California managers who are managing California portfolios were selling their most liquid bonds, which is California general obligation bond. And that's forcing the yield higher. So you want to buy those, right? When they're really, really cheap, because California from a credit perspective is in as good of shape as I've seen them in decades, actually. Then you have another one on the lower end, Riverside County, a toll road in Riverside County. And that bond was coming at $1 price. So think of bonds at a par is 100. It was coming at $1 price on the secondary market of 72. 72. Now, this was a triple B rated bond, nothing that we thought would ever default, but it was a 3% coupon. And that bond, from a structural perspective, got hit really hard. I like that bond. Give you another one. Another one. How about this one? Even better. Outside of California, we bought Chicago O'Hare Airport bond. Okay. Single A rated, so it's a mid-grade bond. Okay. Bought that a couple of weeks ago. And I'm going to put a little twist on it. Okay. It had a taxable equivalent yield. So if you take the tax-exempt municipal yield and gross it up for taxes, so what would a taxable bond, so how would it look on taxable equivalent basis? And the yield on it was 7.03%. On that same day, the high yield junk, or the high yield corporate index, or the junk corporate index, junk bond index, was yielding 6.8. So I could get more yield in a mid-grade municipal airport bond than I was getting in the junk corporate bond market. So what that tells everyone is that it should tell everyone, it was telling us, the municipal market was oversold. It was getting too cheap. And remember, nothing stays cheap forever. So here's what was happening. So you have bonds that were cheap, then all these idiosyncratic names were getting really, really cheap. Yields were too high. We started to see crossover buyers. What I mean by that, buyers who typically buy taxable bonds. Think of your banks and insurance companies. They were recognizing how cheap municipal bonds were. They started buying more on the longer end of the yield curve, long bonds. But there were still outflows in the municipal market. But then what I was, and Loreen, we may have talked about this more recently, is that summer, what I'll call summer technical. And guys, everyone, there's a seasonality to the municipal market, which is comforting in a way. Sometimes it's not, but you can set your watch by this next point that I'll tell you. That every June, July, and August, two things happen in the municipal market. Number one, you have a woeful lack of supply. So municipalities are not issuing a lot of debt. For the simple reason, people go on vacation in the summer, so there's not a lot of activity, to be honest with you. So not a lot of bonds are being issued. But what that's met with is a significant amount of reinvestment. Reinvestment that comes in the form of bonds paying their coupon payments, bonds maturing, and bonds being called away. And there's always a mismatch. There's always more reinvestment than there are bonds. So this year, that will total about $60 billion. So there will be $60 billion of cash that needs to be reinvested more than bonds to buy. So all things being equal, and I know they rarely are, but all things being equal, the municipal market rallies. It's a nice tailwind to the market in the summer months. So here I'm looking at all this data. Municipal bonds are cheap. You have municipal bonds that are yielding more than junk corporate bonds. We have crossover buyers coming in, and there's an enormous amount of cash about to come into the market. And so I was expecting bonds to rally. So what we were doing in portfolios, I was buying more credit, more single A, more triple B rated bonds. I extended our duration. So we took our duration from a little under, let's say, about 4.3 years up to now we're closer to 6. It's come off of that a little bit. So we kind of moving with our benchmark a little bit, if you will, and expecting yields to fall and those longer bonds to rally, right? That's what we were expecting. Now I wish I could tell you all that every decision we make works to perfection. It doesn't. We do not have 1,000 batting average here. We were a little early. And I would say we probably re-risked, but we took a lot of risk down last year, excuse me, and probably re-risked a little bit too soon. But over the last, let's say since May 19th, right, you started to see municipal bonds rally a lot. So if you've looked at your statements, you've seen values increase. And part of that is managers seeing bonds coming to market, right, before the beginning of the summer, before June 1, and they had a lot of cash coming. So they began to buy bonds on the new issue market, and that started to push yields down. I'll give you an example. Illinois general obligation bond. They issued about 1.25 billion about 2 weeks ago, and there were about 5 times more bids than there were bonds. So they had almost $6 billion in bids, and they only had $1.25 billion to sell. And the reason that bond settles June 8th, after the summer, after those June 1 payments come in, right? So that started to push the market ahead, and we saw bonds continue to rally to where they are today. They've rallied a lot over the last week or so, upwards of about 3% or so in 1 week. Now, one thing I will tell you real quickly, and then I can be quiet because Loreen knows me. I'll just keep going. So real quiet here, a couple of things. I'll mention 2 points. Everyone asks about interest rates. Where are interest rates going? Here's a couple of points. Number one, the market's anticipation of a move by the Federal Reserve at times is worse than the move itself. Just anticipating that move. So what you've seen this year are yields jump higher. They move, especially on the long end. So the 10-year Treasury started out at about 1.50, 1.5%, and it reached about 3.15, and now it's about a 2.85. So it's come down a little bit off its high, and it's drifted lower since the beginning of May, even though the Fed is moving more aggressively on yields, right? So the market has gone a little too far. So what I would tell you going forward is you're likely going to see more volatility on the shorter end of the yield curve rather than the longer end. So if I had some, so like my pencil here, if this is a yield curve, short to long bonds, that yield curve is going to go like this. It's going to flatten, meaning the Fed's going to push up short rates, long rates are going to hang in there. Because remember, what is the Fed trying to do? They're trying to slow the economy in order to get inflation under control. The Federal Reserve does not control intermediate or long yields. That is a reflection of economic activity. If economic activity is beginning to slow, long yields are not going to continue to march higher. They're not. Short yields will, but long yields will not. And you're starting to see the crack in the inflation armor, if you will. You're starting to see that occur. Certain sectors, you're starting to see inflation come in a little bit lower, and it's a process. It'll take time. And the other thing I will mention is from a just from a pure yield perspective, it can't continue to march higher. The only way I guess it could is if the Fed is just, if inflation continues to march higher and they can't control it, so the market will anticipate higher yields. Remember the anticipation of it. And right now the market is anticipating flat yields to declining yields over time, at least on the long end. Okay, so, but always remember that the long end, okay, the long end of the yield curve is a reflection of economic activity. The Fed does not control that. They control the shorter end. So I'll just pause there. And
Great.
Loreen, please, any questions?
Daryl, I have a number of questions for you that I'm hoping you can help address for our clients here. And one is, people go into municipal bonds because they are considered more conservative.
Yes.
And yet, this year is not reflective in that idea of being conservative. And so please reassure our clients that municipal bonds are still conservative investments. And why would they want to continue to be invested in municipal bonds?
You're right. No, they haven't been very conservative this year, right? And so there are times, and you mentioned 1994, Loreen, and I can go back over last 30 plus years. And there's only been 2 years for us personally where we've had a negative return in our portfolios. This will probably be the 3rd year, right? And 1994, 2013, and now 2022. The similarities between those 3 years is that interest rates moved very sharply in a very brief period of time. And how bonds work, it's like drinking from a funnel, right? Or a fire hose. It's too much of a yield move and for the portfolio to absorb it. But when you look out 1 year out, let's say 95 returns, Bonds were up 14%. I'm not saying that's going to happen in 2023, but they recovered. 2014, bonds were up about 8%. Okay, we'll see what 2023 brings, but I think when you have such a sharp move in yields, the bonds don't feel as safe because they just need time to now heal themselves and repair themselves, because yields are not going to continue to march the way they have. So will they get back to playing their role, which is, I would argue, their role is to be the bedrock of an overall asset allocation? Absolutely, they will. And they'll provide a better, they'll be even more of that offset, because now your yield is higher. Remember, the yield to start the year was about 1.25, and the yield today is about 3.5.
Right, which, a couple things that you mentioned, absolutely. The year after year like this tends to have excellent returns.
Yes.
In the municipal bond space when we've had, and even remember in 2020, we had a bump in the road with municipals, and by year end, we had a positive municipal bond portfolio.
That's right.
So remember, everybody, even, municipal bonds are still considered conservative, even though this year doesn't feel like it. Another question for you, two really. One is on, putting money in, and the other is taking money out. So we have some people that are going to need money coming out of municipal bonds. We have some people that really want to put money into municipal bonds. And so can you speak about both sides of that?
In what sense though, Loreen? In this environment where we are today?
Yeah.
Okay. So couple of things, and I know sometimes what my first statement's going to a lot of people say, oh, Daryl, that's easier said than done. And that is, try not to get too emotional, right? The last thing you want to do is buy high and sell low, right? We don't want the opposite. We want to buy low and sell high, right? That's the idea. But sometimes the emotion takes hold. So in terms of when adding money in, that's easy, right? When bonds are on sale, you do want to add. Now, and I've been cautioning many investors over the last few months, is to not put it all in at one, dollar cost average in, simply because there's too much uncertainty in the market. Even though I can tell you probably over the next year with more clarity what will happen versus what's going to happen in the next 30 days, right? Sometimes you have a little longer time horizon, you'll have a little bit more clarity. So I was telling people to be more dollar cost average in, because I know bonds were on sale, but were they at their absolute low point? I did not know that May 18th was the low point. I did not know that. I knew coming around the summertime it would be. Now, you want to be mindful in selling bonds in this environment, because especially on days, Loreen, where it is that you can be illiquid, right? And let's say you have a bond that we're going out to sell, and the client really wants their money. They need it, they want it. And the bond, I'm making it up just for a hypothetical, the bond has a dollar price of 110. That's the value of the bond. And we go out, and the best price we can get is 106, right? Taking a 4-point hit on that bond. That should not be. Right? But when markets get somewhat illiquid, that can happen. So when the market's when all you see is every day, it seems like your values are going down, that you want to be mindful of selling into that, because you can be taken advantage of. It's good to be a buyer in that environment. It's not good to be a seller. Right now, it's really good to be a seller in this over the last week. You want to sell and continue to dollar cost average in, because the market got so grabby. It didn't matter what we were throwing out there to sell, everyone would buy it. And if they buy anything. So you want to be mindful of that. Just just kind of read the field, know the environment you're in. And if you're going to add money, be cautious. I don't have a, perfect crystal ball. And we do have
we've been saying the same thing over, whether it's equities or fixed income, the next number of months. And so I'm talking to people about, let's figure out, how much you want to get in, and let's do it over a period of time, every month, just like you said. So that's good.
Absolutely.
Now, talk about the difference between, using this strategy in a separately managed account versus using a broker to purchase individual municipal bonds. And can you explain the difference and why investors should look at the SMA versus a retail purchasing of munis?
Well, there's a couple of things there, right? So when a broker is buying a bond, right, he's buying a bond. He's not building a portfolio, right? So he's just buying a string of bonds, whatever they may be. You don't know if you're getting the right best execution on that bond. There is a sense of a markup you want to be mindful of. So my trading desk is not a profit center. And whatever bond we buy, the price we buy the bond at is the price our clients get the bond at. Where in a broker, in many instances, the trading desk is a profit center. So they want to make money on the trade. So they're going to mark up the bond a little bit. Sometimes even the advisor, not always, but sometimes the advisor can put a little markup because they want to make a little money. So you want to be mindful of that. Also, those portfolios tend to be, how will I say, passive, right? They're not going to move. They're just, you buy it, you hold it, you're stuck in it until that bond matures or gets called away. From an active perspective, what we're doing, first of all, many brokers have an inventory of bonds, right? They look at their inventory and they're going to pull bonds out of that inventory. Now, the question you have to ask yourself is, well, pulling that bond out of inventory, is that in my best interest as a client, or is that in the broker, the firm's best interest of getting that bond off of their inventory, right, out of their inventory? So there's a question of who is that the right bond for the client. Now, I don't have an inventory of bonds, but what I do is surveil. I have access to inventories of other managers, well, I should say brokers, right? So I have access into, Merrill Lynch, JP Morgan, others, right? And I can see the entire market out there, and I can go out and choose the best bond. Now, and as I mentioned, I don't mark up the bonds that we buy. Whatever price we get is what price the client gets. Now, a couple of points in there, not to get too nuanced, but as an active manager, what I want to make sure is that the bond portfolio best represents what is going on out there in the marketplace. So if the market is very volatile and I need to be more protective, I'm going to be more protective. Like last year, we took our interest rate risk down. We increased credit quality to improve our portfolios. But when there are opportunities to be more opportunistic without undermining the integrity, we want to, again, change the portfolios, whether that means adding some more credit, single A, triple B rated bonds, or adding duration back in, right? So we will make those shifts. And when I look at, and this is not my data, this is Morningstar data. And Morningstar tracks fund managers as well as SMA managers. And when you look at active managers versus passive managers, and we're just part of the group of active, that 97% of the time over rolling 2-year periods, active managers outperform passive managers. 97% of the time. If you do anything 70%, that's great, right? But 97% of the time, a passive strategy, if you will, Loreen, sounds enticing, but in a market that is highly inefficient, like the municipal market is, you're leaving, I would say, you're leaving money on the table.
So I agree. I think that's just it's a misnomer. It's perception about, people are thinking about it the same way they think about equities, but
Yeah.
Municipal bonds are very different than equities in the way that they're traded, they're sold, etc. So really good reason to be using active money management, why we choose to use this strategy versus individual bonds that we're picking. We believe it's best left to you in the institutional realm to get the very best pricing on behalf of our clients. But go ahead and explain the MISH account within your portfolio and how you really manage that. And also talk a little bit about duration and what you're doing in that area.
So for those of you, MISH stands for Municipal Income Share. It is you can call it an income share, that's part of the name. I call it a completion fund. Some people call it a commingled vehicle. A couple of things to know about it. Number one, it's an open-end, what you would call 40 Act mutual fund. So it's a typical mutual fund that you would find in the retail market, right? But two big differences. A, you can't buy it on the retail market, so it's only accessible through this strategy, nor there are no fees associated with it. Okay, so what we're doing is bringing the best of both worlds together, meaning all the individual bonds that you have in your portfolios, they are AA and AAA rated. If you looked at their durations, which I'll explain in a minute, they probably roughly have a 4.25-year duration, 4.25 years. And then you have the completion vehicle. That's where we house the single A rated bonds, triple B rated bonds, and there's some high yield in there. Now, why do I say we're bringing the best of both worlds together? Because what that provides you is an enormous amount of liquidity, an enormous amount of diversification. That portfolio is close to $8 billion. That fund is $8 billion. There's about 600 issues in it. So it's very deep, diversified, and it allows you access. So when Loreen brought up what happens if a client wants to sell? If I were to go out and sell a small block of a triple B rated bond or a single A rated bond, you're going to get skewered on that price. That's just what the market does, right? They don't want to be bothered with a smaller price of triple B rated bond. They're going to give you a terrible bid on it. So what we did, we were the first ones to bring it to the municipal market, this form of a completion fund, because we wanted access to that corner of the market in a very liquid and diversified way. That was the idea. So some people say, hey, Daryl, you know what? Then I'll just go out and buy a bunch of high-grade bonds and bolt on the side of it a mutual fund. You could do that, but two things. A, you're double dipping on fees because you're paying fees on the mutual fund and most likely fees on the individual bond. And number two, the right hand doesn't know what the left hand is doing. They each have their own mandate. Now, so they're operating independent of one another. What we're doing, it's kind of hand in glove. We're managing those to get to the best outcome or the mandate for our clients. So that's it. And by the way, what I did was a few years ago, it's an evergreen piece. I did a little piece on completion vehicles. It's one page back and front. So if you want that, Dan is internal. It can get that to you. If you want to share it with clients, you can go out right ahead. It's client approved. It's again, it's an evergreen piece. I wrote it a few years ago. In terms of duration, everyone should understand what duration is. And I would argue that duration is the most important metric of a bond portfolio. It measures interest rate risk. It's measured in years, but it's not maturity. It's a function of its maturity. And so, for example, if interest rates go up 1% overnight and you have a 5-year duration portfolio, the value of the portfolio will go down 5%. Not the total return, but the value. If you have a 10-year duration, same thing. Yields go up 1%, the value goes down 10, okay? And vice versa, right? If yields fall, up 5 or 10. So what you want to do, what I don't think anyone can do with accurately or effectively over time is predict the absolute level of rates or yields. Right? I mean, the Fed has inside information and they can't get it right, let alone anybody else thinking that they can get it right. So we're not going to take big bets on duration, right? So I will move it a little bit. Last year, we were about 4.3 year. Today, we're about 6. That's kind of the high end. And given how the market's rallied, that's going to come down a little bit. But the duration is a key tool to managing volatility and risk in a portfolio. And today, where we are right around that will be a little less than 6 years. Home base is right around 5.25. That's where we like to be. And what we will do, move more around, if you will, is the maturity structure. So even though I don't think anybody can predict the absolute level of yields, what I think we can do with a far greater degree of reliability is predict which way the yield curve shifts. So sometimes it's steep and it flattens out. Sometimes it's flat, it goes steep. So that is much more predictable. So where we're buying bonds matters along the yield curve, as long as we're averaging out to our target duration. Hopefully that got to your question.
Yeah, and what percentage is in the MISH right now?
42%. The most we could be is 45. So we're at 42. And some people say, hey, Daryl, why not take it down? Why not? And we have a lot of flexibility there. So we're at 42, but remember, I can get under the hood. So I can take it from 42 down to 35, but that will trigger capital gain ramifications for many, many investors. And not only that, I'm going to have to sell bonds inside of it, and that could trigger a capital gain distribution as well. We're
So
trying to avoid that.
you use flows to then adjust the percentage versus selling. You
That's
could bring in more flow and then more into individual bonds if you wanted to reduce it.
Well, what do you mean by that? Say that again. Let me make
In
sure I
other words,
understand that.
instead of adding money into the MISH, you can add it into the individual bonds, and then eventually that percentage would come down.
If we were going, yes, if we were going to do that, would take a long time, right? To do that, right? So you could do that.
If you wanted to reduce it, what would you do? You'd have to sell.
Yes and no, right? I'll go under the hood, right? Get into the completion fund and say, okay, what's my goal? If my goal of reducing the completion fund, let's say from 42 to 40 or 35, is to have less credit risk, right? That means if I'm lowering it, I want less credit risk. So, okay, what's another way to do that? Well, all I need to do is go under the hood and start selling bonds within the fund, because then I can offset gains and losses within it, and I can get to, so I can keep it at 42, but sell a whole bunch of triple B rated bonds and buy a whole bunch of double A rated bonds in the completion vehicle.
Right.
And that gets me to the same place, even though I left it at 42. And this way there's no capital gain distribution.
Yeah.
So you get the best of both worlds, right? The best outcome, two birds with one stone, if you will.
Yeah.
I have a lot of flexibility there.
Yeah, that's good. That's good. And remind everybody, how long have you been doing this?
Oh boy. I've been in municipal bonds now for over 30 years. I started my career at Moody's Investor Service, one of the rating agencies, and moved on to a bond insurance company, financial guarantee insurance company. I've been here, so I was there for Moody's for about 5, financial guarantee insurance for 6. I've been here for just past my 20th year here. Good thing is I get 2 extra weeks of vacation that I'll never take, but it's nice. It's a nice gesture anyway. So I'll get, but that's only for the next 12 months. Then they pull it right back. But anyway, it's a nice gesture. So I've been here for, just over 20 years now.
Fantastic. And the stability of this investment shows. Dan, I'm going to let you ask, is there any question that you want to ask? And John, I'm going to ask John Milligan in my office, any questions, and then we're going to open it up to anybody else. John, Dan, did you have anything you wanted Daryl to talk about?
Just 2 things real quick. Loreen, as you mentioned, Daryl's experience and his 20 years with us. Some people have read the book on municipal bond investing, and he hates when I bring this up. He actually helped write the book on municipal bond investing, and the chapter that he wrote in the book is about airport bonds. So some people have read the book. He actually wrote the book on tax-free municipal bonds.
Love it. Very impressive.
The second thing I wanted to get Daryl's perspective on. Daryl, you and your colleagues have taught me during periods of market volatility in the muni market to think of investing in tax-free municipal bonds somewhat similar to being a real estate investor. And when you're a real estate investor and you buy a piece of property, you then have a tenant in that property that pays you rent every month. And we like to think of tax-free municipal bonds as the rental property of the investment business. So we kind of carry that analogy through. If I own tax-free municipal bonds, I've basically got this little piece of property, and then the individual paying me rent is going to be, say, here in the state of California, it's going to be the state of California. So the state of California, it's my understanding last year had a $46 billion surplus. And then our fiscal year ends on June 30th. And I was wondering, are we also running a surplus? And this will really help everybody on the Zoom understand the financial strength of the states that are going to be paying them back when they get periods of volatility, to know that they are going to make the payments. And that's really my question.
Oh, no, yes. As I mentioned earlier, the financial position of municipalities in general are as strong as they've been, is as strong as they've been since before the financial crisis. Now, California specifically, yes, California, it's I don't want to say obscene, but they are running some sizable budget surpluses here. And that occurred because tax revenues have come in much stronger than anticipated, and you had a very, very generous federal government in terms of stimulus monies. And by the way, stimulus monies are not over. The second tranche of stimulus monies have been just recently distributed, right? So California is in phenomenal financial shape, and that kind of bleeds down, right? Because a lot of, whether it's school districts clearly rely on the state, counties second to that, and then it's your cities, towns, if you will, that rely somewhat on the state. So that will filter down from financial aid, state aid to municipalities. So yes, Dan, the states and municipalities are in great shape. California's tax revenues were up 33% last year relative to the year before. And again, they're running a size, they have the largest cash funded reserves they've ever had.
And unlike other states that are returning some of that money back to taxpayers in various forms, the state of California has no intention of that. They're keeping all that money, which the only way to benefit then is be a municipal bond owner and get that money through your municipal bond.
Yeah, no, you're not getting it back. Oh, no.
No, not in California. Okay, John, any questions on municipal bonds?
Yeah, you'd mentioned that, last year you saw that municipal bonds got, kind of pricey. What are some of the measures that you would state as it, purely spreads, or what puts something into the definition of being overpriced, as you'd mentioned, and what do you target first on the selling side, be it, credit or anything else, to kind of get out of some of those overpriced positions?
Well, it depends, right? Where there's two things. There's things that are, overbought, you can say, or oversold, right? So things that were last year, you can argue were overbought, and that caused prices to become too high, right? And you're looking at that relative to a number of things. You can look at what's called muni treasury ratio that I talked about a little bit before. After tax spreads is another way to look at it, or you can look at it relative to itself and where it's been historically and where it is today. So that's one way. Oversold is what we've seen more recently, where investors are just fleeing the market, and as managers are selling, that's driving yields up and prices down. And again, it's a similar kind of a thought process: is what is the ratio? Or is it above average or less than average? After tax spreads, above or below average? And then again, looking at more of those idiosyncratic. So as I mentioned, California at a 100 basis point spread to a national AAA is way too high. I'm in New York, okay? And there's a type of bond in New York. It's called the New York City Transitional Finance Authority bond. But what that bond is backed by personal income taxes of New York City. And if that's insufficient, sales taxes. That bond is as AAA. It is as solid as it comes. I refer to it as a belly button bond. In New York, it's a belly button bond because everyone has one, right? And if you want somebody to take more of that one bond, it has to be cheaper. And that bond usually comes with a 30, 35 basis point spread, and that's over 100 basis points, right? So there are telltale signs that you look at. Now, if we're selling, what are we looking to sell? And that's it depends, right? So for example, depends on how much the client wants to take out, because what I don't want to do is upset the balance of the portfolio, meaning that I'm making it up, you have $1 million portfolio and somebody wants to raise $100,000, okay? And you take all of that $100,000 out of the completion fund, right? Because that is the most liquid way to do it. Well, what that's going to do is cause the portfolio to be too high credit quality and not enough credit. And eventually I'm going to have to sell on the high grade side to get back in. Ideally, get back into credit. Ideally, what I would like to do is sell a little bit of both. As Loreen asked me, how much do we have in the credit in municipal income share? 42%. So if somebody wants $100,000, ideally 42,000 comes from the completion fund, right, to keep the percentages right, and 58,000 comes from the individual bonds. So this way I don't upset the integrity of the portfolio. But a lot of that is feel in the market. I rely on my traders a lot to guide me of where the pockets are. Hey, Daryl, don't sell California general obligation bonds. You'd rather sell, LA Airport or SFO, whatever, you're getting a better bid there, right? And there may be losses there. You want to take some losses, all right? So it depends, but it is somewhat a feel game out there, if you will, when we're trying to sell or buy.
Thank you.
Thank
You're welcome,
you.
John.
Okay, I want to open it up. If anybody on the call has any questions for Daryl, if you do, please unmute yourself and feel free to ask a question. We'll wait for a moment to see if anybody on the line has questions. Of course, you're free to ask me any questions after the call. We'll get back to you with the answers, whatever questions you have. Let's see if I don't think anybody has a question right now. So,
Hey, Daryl, I think everybody wants to know what the exact title is of the book that you co-authored.
No,
So
they really don't, actually. They don't want to know that at all.
It's called The Handbook of Municipal Bonds, and you can get it on Amazon. And he co-authored the chapter on how to analyze airport revenue bonds in the book, just in case everybody wants to get that